My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain what's going on. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How do you wind up with a day where the market's recent leaders lose their mojo and money managers rotate back to some of the old leaders like big tech? You can't tell the story from the average Dow dipping 7 points, S&P inching down 0.05%, NASDAQ gaining 0.18%. But daily today, the big buyers can't help themselves, and they leave huge footprints. They have to reach for Microsoft. They have to have Meta. They need Google. Why? Look, I've been getting more worried about the bond market. I've been saying that ever since the Fed cut rates last month, right? Bond prices have plunged. Bond yields, meaning longer-term interest rates, have soared. Not supposed to happen. But when it does happen, money managers reach for the companies that simply aren't impacted by the change in the 10-year, the 20-year, or the 30-year U.S. Treasuries. Rates don't matter all that much to Microsoft or Meta or Google. Neither they nor their clients need to borrow large sums of money, so the bond markets are irrelevant to them. I love the lump in Apple and Nvidia, but they were up real big yesterday, so they don't have what Microsoft had today. They don't have the mojo. Does this move make any sense whatsoever? Okay, look, I'd say it's pretty much intellectually bankrupt, but who cares? Sometimes Wall Street's like Chinatown, as in, forget it, Jake, this is Wall Street. Meaning, don't bother to figure it out. It is what it is. But you come to me to figure out, how's this happen? How can people abandon the market's recent winners so quickly, dropping them like hot French fries right into our lap? Simple. See, this morning we got a series of earnings reports that just didn't add up. They didn't fit the thesis. They were disappointing. They don't jive with a rather benign moment when we have the Fed cutting rates, yet employment remains strong. When we get these problematic quarters, several in one day, I might add, money managers default back to the tried and true growth stories that we all know and love. Yes, titans of tech. You know what? These managers can't help themselves. They feel they have to rotate out of what was hot at one point and into something else that's not that impacted by the big rate cut cycle. Here's what I want to do. I want to start with the alleged earnings disappointment. I only use the word alleged because these are really good companies, and I don't want to slam them. Number one is GE Aerospace, long a favorite of mine. Today we learned that there was some weakness in some orders and some lingering supply chain issues when it came to building aircraft engines. Now, it wouldn't be a big deal, except the stock was already up 90% for the year as of last night's close. So people sold first and then asked questions later. They don't think, hey, wait a second, GE has years of demand ahead and aerospace is a great secular growth market. No, that takes wisdom, genuine wisdom. And who the heck has time for wisdom when you can just bring the register? And that's how a fantastic stock like GE Aerospace closes down 9% and no more than that. Then we go to Pulte Group. Yeah, the big home builder reported what looked like a Jim Dandy quarter. But when you look underneath, you see newfound rot incentives. That was the point. Pulte has to now offer incentives for people to buy homes. The conference call bummed people out because CFO Bob O'Shaughnessy said, and I'm going to quote here, "We expect incentives to remain elevated for at least the remainder of the year," end quote. Huh? What incentives? Aren't the home builders reeling in the money? We don't need no stinking incentives. But then again, loan rates just keep running higher, and that means mortgage rates are moving up. With mortgage rates expensive again, something has to give, and it might be the price of a house, and that's how Pulte plunged more than 7% today. Okay, how about America's best steel company, Nucor? Now, this is supposed to be a huge winner for the Fed cutting rates, but as you'll learn later in the show, steel pricing is horrible right now. So Nucor gave a dismal forecast for the current quarter. Frankly, it kind of took people by surprise. When you do something that causes big estimate cuts, money managers don't try to look past that. They don't know about how Nucor will have a big year in 2025. The Fed keeps cutting, but you got to cut now. They say, get me into something that makes the numbers, and then we'll forget about Nucor. And that's what happens. And that's how the stock of Nucor goes down 6.5%. Now, we all love the autos. GM had a good number, by the way. But what about the auto parts plays? Shouldn't they be good? Don't we like genuine parts? We should, but not when it whiffs horribly. A gigantic miss. You look at the thing, you think, we have so many old cars on the road, you need to fix them. With genuine parts, it seems like a can't miss story. Then you listen to the conference call of Genuine Parts, and CEO Will Stengel tells us Genuine's getting slammed by conditions in Europe and their industrial business. Well, most people didn't even know there is an industrial business in Europe, and an American story. So, once again, get me out of that one pronto, and that's how Genuine Parts' stock gets pummeled for a 21% loss. How about safety? Can't we huddle in safety, right? Isn't that what you're supposed to do when things are uncertain? The action in Kimberly-Clark says apparently not. The maker of Kleenex, as well as all sorts of diapers, had some one-off problems that hurt the quarter. So the seller's body slammed the darn thing. If you own it, you wish you were wearing Depends, which, by the way, are the quintessential Amazon products, because who wants to buy adult diapers at CVS, let alone Walgreens? I think Kimberly-Clark's problems really are one-off. The buyers will come back, but not today. Not today, Satan. That's why the stock closes down 4.5%. So what happens? The disillusioned souls who trade these stocks, and they have been winners. Remember, these people do not own. They rent stocks, and they move their money to stocks that they feel safe and comfortable. That's why Microsoft started going up right at the opening bell. Here's a company with an amazing balance sheet, selling indispensable products to 100 million people around the world, people who pay on time regardless of how the economy's doing. No need for Depends there. You go to Meta, which also has an amazing balance sheet and extraordinary demand for its products. Their AI Ray-Bans are a huge hit, but that's barely a drop in the ocean because they can make so much money from the targeted advertising business, and they will. Or how about Amazon, which is closing in on its all-time high, again, just over 10 points from here, even as it last quarter was hated. Suddenly, though, Amazon's love for its consistency, long-term consistency, I guess. They like Google for the same reason they like Amazon and Meta, targeted ads, referenced again and again as a place to advertise pretty much anything. Now, I know I left out Apple, NVIDIA, and Tesla, but for good reason. See, today we got some negative news about iPhone sales. Not enough to make me want to sell, but enough to ding the stock. And that wasn't just analyst reports. You also got a number from Verizon that didn't jive with the thesis that Apple iPhone's selling well. NVIDIA didn't get much love either, but CEO Jensen Huang is headed to India for a fireside chat at an AI conference. Hey, maybe he'll announce a giant sovereign state contract, something he's been hinting at. I would own, not trade, Apple and NVIDIA. Tesla, it's a car company, so it's genuinely sensitive to the bond market. No, thank you. They actually have an interest rate concern now that we don't think about them as a robot company. So, yes, the money does flow back to tech titans when the 10-year treasury goes down in price and up in yield. On days like today, big money managers, they get scared of cyclicals and nervous about aerospace, frightened of home builders, supervised by auto parts, and chilled by Kleenex sales. What matters, though, is that we've seen this movie before. It's been happening for more than a decade. Don't worry, the money can rotate just as soon right back to where it was, but you got to wait a couple of days, or maybe even just a day. That's how crazy things are. But the bottom line, big tech made a big comeback today because of the bond market, not anything to do with the stocks themselves. So keep in mind that the pause in the rally is temporary, even as you should still own some of the Mag 7 for diversification. They used to be high flyers, but now they've become lovey blanket stocks. Money managers can't live without their lovey blanket stocks when there is genuine economic risk involved in other kinds of stocks that they didn't expect or didn't think that would happen. You know what? Again, nothing too serious, and I would buy almost every one of the stocks that I mentioned that were down badly today. Let's go to Amy in Pennsylvania. Amy.
Hey, booyah, Jim. How you doing tonight?
I'm doing well. How about you, Amy?
I am awesome. You and your team have an amazing show, and thank you for putting some more jingle jangle into our pockets.
Oh, well, thank you. And the team is amazing. I've been listening to the team. I actually heard them today, which was really quite a change for me. What's going on?
Hey, so McDonald's was one of the first stocks I ever bought. It was a great stock to keep, but considering right around close, it dipped down like $24 a share. So should I ride this out, or should I get the heck rid of it while I'm still ahead?
Amy, this is a great teaching lesson for me and for you. Okay, so McDonald's did have an E. coli link. Apparently it was with onions, not beef. They did manage to pull everything that was in the quarter. Everything that is connected with this has been pulled. 10 states only. Do I want to advocate buying a stock down 21 without more knowledge? I will tell you this. I think McDonald's is a great company. I think McDonald's is about to report next week. I think McDonald's is going to have a terrific quarter. If somebody downgrades the stock tomorrow on this, then I would indeed pull the trigger. Stephen in Florida. Stephen.
Jim, big hurricane hit Florida. Booyah to you.
Man, I hope everybody's okay, booyah. These hurricanes are really scary. How can I help?
Well, my question's actually from my kids, Alex and Addison. I've always told them that they need to buy what they know, and of course now they're holding Disney in their portfolios. It's actually the only non-tech stock they have, and it's been a dud. But it looks like it's on the bottom. Is it going to find some footing? Or
I totally agree with you. Jeff Marks and I went over Disney this morning when we did our morning call at 10:20 for the exclusive for the CNBC Investing Club people. We felt very inclined, as you did. We think it's bottom. I actually even traced out the chart. I said it is time to buy Disney. Don't forget, they got the big ships coming online, and you know what? They got to It's so much better than a $96 stock. It's ridiculous. All right, you have to keep in mind that the pause in the big tech rally is temporary. I still think you got to own some of the Mag 7. They've become lovely blanket stocks. How crazy is that? You get diversified with them. On Mad Money tonight, Logitech is falling after it's raising its full-year guidance. I have to tell you, I was puzzled about this. I'm going to be digging into the decline with the CEO, hearing more about its place in the computer hardware space, and don't forget gaming. Then how could rates and future Fed cuts affect the material stocks? As I mentioned, Nucor pulled back big today. Let's take a deeper dive at Nucor. It's too good a company to just leave on the periphery. Plus, industrial REIT Prologis crossed the tape last week, reporting softer occupancy and rent. I'm checking with the company's top brass to get a better read on demand of a company that I have liked since 2009, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Okay, what the heck just happened to the stock of Logitech International? The company specializes in computer peripherals like keyboards, mice, and webcams, along with gaming accessories, tablet accessories, and all sorts of electronics. Whenever earnings season comes around, this stock tends to be a wild trader. Last night, Logitech reported a clean top and bottom line beat, with management even raising their full-year forecast. Yet, for whatever reason, and believe me, I've been searching all afternoon, the stock plunged 8.5% today. The culprit, well, there's some nitpicking of Logitech's guidance. Even though they raised their outlook for the second straight quarter, it still implies zero sales growth with flatter declining margins. I got to find out more about that. If you think it sounds unfair, well, so do I. This could be a tremendous buying opportunity. And if I'm right, and we're headed for a new PC refresh cycle, you want to own this stock. Don't take it from me. Let's check in with Hanneke Faber. She is the CEO of Logitech International. Get a better read in the quarter. Ms. Faber, welcome back to Mad Money.
Thanks, Jim. Thanks for having me.
Well, Hanneke, I'm glad you're here because I did have to admit that I spent some time trying to figure out what the analysts were talking about because you did raise. The analysts seem to be concerned that you're spending and it's not giving you a return. I want to put the ball in your court because that doesn't seem to be right. I think that you're doing real well and business is good, but there was skepticism. So maybe you can explain it because I don't understand it.
Yeah, thanks, Jim. Well, we completely agree with you. This was a great quarter, actually, a quarter of high quality growth. Net sales up 6%, driven by demand. Growth that was broad based across all regions, all categories, and across B2B and B2C. It was a quarter in which we grew gross margins by more than 200 basis points. And all of that gave us a lot of confidence to raise guidance.
Now, I also think that it's important to point out that you're a company that actually spews cash. You have a lot of cash on the balance sheet. You have the ability, if you want to be able to buy all the stock you want to down here. When you see something like this, where it confuses you and it confuses me, are you inclined to be able to say, you know what, I'm going to take advantage of it with $1.4 billion in cash and buy in stock?
Yeah, well, we have been buying back a lot of stock, and certainly we'll keep doing that.
Good. Okay, because I feel better about that. And you have 18 new products in gaming. So those who think that gaming may have stalled out, you would not be introducing 18 new products into a market that you think is stalling out.
No, gaming is one of the key tailwinds for our business. The market's really robust. It has been robust globally, but we also saw in the last quarter that the U.S. gaming market is up, which is great. We are gaining share in the U.S. and in Europe. And indeed, we've come out with a fabulous portfolio of innovations for the holidays. 18 new products, including a new Pro lineup, a new series of wheels and accessories for wheels, the new A50 headset, and fantastic collaborations with Genshin Impact, really popular game around the world, and Momo, the high-end steering wheels.
Now, I'm sure there was a time when you'd hear those games, you say, oh, my, that's all made in China. If President Trump wins to be president again, well, then Logitech's numbers could take a hit. But you've been pretty good at diversifying away from China since we've been following the company all these years.
Absolutely. This is a long-standing practice at Logitech, and we have a great team who roll with the punches of whatever happens in the supply chain. So a very large part of our business is not sourced from China, and we're ready for whatever might come after the elections.
All right, let's talk about the PC refresh cycle. In the last few weeks, we've been getting a little pushback. I had been very bullish about the idea. You got the AI PC, and even if you didn't, it's been 4 years since the boom, and that tends to be the time when people decide that they need a new PC. Is it playing out? Is the new PC refresh cycle playing out?
Yeah, I would say there is a mild PC refresh cycle, which is a good thing. We never see a direct correlation to Logitech's business, but clearly when people get a new PC, we do a great job in stores of placing our products very near, both online and in actual bricks and mortar stores, very near PCs. So we see a little bit of benefit from that, and we believe that PC refresh cycle will continue into the new year.
Okay. Now, your new hire guidance does imply that net sales in the second half of fiscal 2025 could be flat or down slightly, and your operating margins, your profitability, could come in a little bit light. Is that a correct interpretation, or is that too negative a spin?
Yeah, I would say that's too negative a spin. We've been saying for the last 2 quarters that what's happening in this fiscal year is that our net sales our sales in the first half of our fiscal, which just ended, will be higher than sales out. That's because we ended last year with inventory simply too low. We didn't have enough products on shelf, and if there's no product on shelf, you can't buy us. So we needed to sell in a little more to get those inventories, to get those shelves stocked. We've said that all along. First half sell in higher than sell out. Second half sell out will be higher than the sell in. And we actually see demand really robust. That gives us confidence, and we expect it to be robust throughout the second half of our fiscal year. And gross margins, for the year, we expect them to be between 42 and 43%, which is at a very high level in our industry, and we're really pleased with that.
Well, then I have to admit I'm confused to the positive for Logitech. And after making a lot of calls, I think that I was shadowboxing against the Bears today because you got a return from work thesis that is still working, right? I mean, that's not gone away, that people are still working from home at a certain percentage, correct?
Absolutely, and that continues to be a tailwind for us as well. We see around the world is about 50% of people working hybrid now. That's great for our video conferencing business. That was up 5% in the quarter. But it's also great because people need peripherals both in the office and at home. So we saw especially our mice, keyboards doing very well in the B2B channel as well.
All right. Look, I want to thank you because it puts to rest a lot of my concerns. I'm sorry that I was so confused just because, you get these analysts and they've got a series of negative questions. But when you read over, I have to do a broader thesis than the analyst can. Obviously, I cover a lot of companies. But I think this was a terrific quarter. I'm sticking with your view, Hanneke Faber, CEO of Logitech. And I thank you for coming on Mad Money.
Thank you.
Excellent. And guys, look, they've got to buy back. They obviously believe in the stock. There's much that's good here. We've always been very positively disposed to this stock, and I'm not changing my view at all. Mad Money's back after the break.
Coming up, calling all metalheads, Cramer's getting real on steel. Next.
There are all sorts of groups that can suddenly work when the Fed starts cutting interest rates, as we've seen over the past month, but some of them require more time to turn around. For example, the smokestack industrials and material stocks take a little longer to make a comeback. Take Nucor, America's biggest and best-run steelmaker. Last night, Nucor reported the market was not impressed. The stock ended up plunging $10 or 6.5% today. That's unfortunate because this company's a great bellwether for the whole material sector. And after what we heard last night, it's clearly going to take some time before these stocks can rebound after one rate cut. Now, Nucor's results weren't exactly a surprise. The company issues rough earnings guidance about 2 weeks before the end of every quarter. That was a month ago. And this time, management pre-announced some disappointing earnings per share figures. Wall Street was looking for $1.73 per share. The management said it was expect more than maybe $1.30 to $1.40, thanks to lower pricing caused by weak demand from a host of end markets like autos, farm equipment, and household appliances. But a funny thing happened after that pre-announcement. It didn't seem to matter to the stock. See, even before we got those numbers, Nucor's stock had already fallen 34% from its highs in April to its lows in mid-September. In fact, some analysts started upgrading the entire steel sector in anticipation of the whole economy getting a boost from the Fed's rate cuts. And that's historically what's happened. Long story short, investors were already circling around this one over a month ago, betting that it was ready to bottom. And of course, it's not a coincidence that the stock bottomed on September 11th, right before the Fed leaked that we'd likely get a 50 basis point double rate cut. Once we heard that, the stock caught fire. Because who cares about the current quarter when the Fed's about to become our best friend again? Everybody knows the industrials benefit from rate cuts, so they were willing to look past the weakness in the third quarter. But apparently, they're actually not willing to look past weakness in the fourth quarter, which is what we heard about last night. And that's what torpedoed the stock today. It was kind of a rude awakening. See, the headline numbers for the reported quarter were slightly better than expected after last month's hideous pre-announcement. Even though Nucor's business is down substantially year over year, thanks in large part to weak pricing, they still delivered a clean revenue beat. They earned $1.49 per share, 9 cents better than the high end of the pre-announcement, even as it was 2 cents lower than the analysts were expecting. Those third quarter numbers were awful in absolute terms, though. But everybody knew they'd be bad, and nobody let that bother them for the past month. So what changed here? The outlook. Unfortunately, Nucor's guidance for the current quarter was quite disappointing. And management made some grim comments on the conference call. For the fourth quarter especially, Nucor said that its unadjusted earnings per share will be down from the third quarter they just reported, definitely less than $1.05 per share. Their steel mills and their finished product business are being hit by weaker volumes and lower average selling prices still. The only bright spot is the raw material side of the business, where volumes and pricing are stable while costs are coming down, but it's not enough to move the needle. What's going wrong here? Aside from weakness in key end markets like construction, manufacturing, autos, management called out election uncertainty, geopolitical concerns, product delays, tight lending requirements, and elevated levels of imports for certain steel products. I mean, holy cow, what a parade of horribles. To be fair, Nucor also did call out some potential catalysts that could turn things around, like more rate hikes, more rate cuts, pent-up demand for residential and commercial construction, and an extremely soft landing for the economy. But there's a reason they're potential catalysts and not actual catalysts. It's because they haven't happened yet. Through it all, though, Nucor reaffirmed that they've been navigating economic cycles for 5 decades and emerged stronger every time, and I can tell you that is definitely true. But it's also cold comfort if the fourth quarter is going to be worse than the third quarter. When Nucor held its conference call this morning, it was a bit of a mixed bag. In CEO Leon Topalian's prepared remarks, he explained that, I'm going to quote here, the Federal Reserve's recent actions are a good start, but it will likely take more time, more rate relief, and looser lending conditions before we start to see the flow-through effect in the construction, industrial, and consumer durables market that are so impactful to steel demand, end quote. On the other hand, he called out several markets that do remain quite healthy, including construction related to semiconductor factories, advanced manufacturing facilities, data centers, of course, and institutional buildings. Basically, the Fed is Nucor's friend, but given the nature of the steel business, it takes a few more rate cuts for the friendship to really kind of kick in. Looking into next year and beyond, Topalian pointed to all sorts of things that could turn around things for the steel industry. I agree with him. I think it'll turn. But that doesn't necessarily mean the stock's worth buying on weakness right now. Ultimately, there's a reason the stock plunged 6.5% today. I don't think Nucor's really doing anything wrong at all. I was just hoping we'd see more signs that the material space is turning, especially after all the bottom calls we heard over the past couple months. But the turn clearly isn't here yet. We probably need more rate cuts before I feel comfortable pounding the table on the steel or the other material stocks. And I got to tell you, I talked to Jeff Marks today. We go back and forth for the club. And I was thinking maybe this is the right time to buy Nucor, but I'm a little more circumspect after listening to that call. Now, if you're willing to look a bit further into the future, then I do think Nucor's worth buying on weakness. However, I'm starting to get a little concerned by this relentless rise in longer-term interest rates ever since the rate cut from the Fed last month. Yesterday, we got conflicting messages from Fed. Mary Daly, president of the San Francisco Fed, she says she doesn't see a reason to stop cutting rates. But then Minneapolis Fed President Neil Kashkari says he favors a slower pace of rate cuts. He's currently a non-voting member, still influential. Personally, I'm confident in the Fed. I believe that they've tamed inflation. However, we might not get true clarity on the rate hike front or cut front until after the election. Both candidates have potentially inflationary policies, but in different ways and to different extents. 2 days after the election, we'll learn the outcome of the next Fed meeting. Might be worth putting Nucor on hold until we know more. That's how I'm approaching it. As much as I would like to tell you to dive into Nucor here because I've loved it so long, even in the 80s when I was at Goldman Sachs, I loved it. But after last night's update, I'm a little less sanguine. The weak quarter wasn't a surprise, but the discouraging guidance for the fourth quarter, that was a surprise. It makes it hard to get behind. So let me give you the bottom line. If I had to decide today, I'd still guess that the Fed keeps cutting, rates come down in 2025, and cyclicals like Nucor and the rest of the materials, stocks can be big winners. But you know what? We don't have to decide that today. Given the situation's uncertain, we can keep watching and gathering information for the next couple of weeks. It won't be too late to make a decision on Nucor when we know more about where we're headed. But I am, again, concerned. I know I was premature in thinking it could bottom today. It didn't. I got to wait and see. Jerry in New Jersey. Jerry.
Oh, hi, Jim. My question involves Rio Tinto. It's a stock that I picked up a couple of years ago. He hasn't really been doing too much, and now I'm kind of at a dilemma. Is this something that I want to buy more of, hold on to, or sell it? If I sell it, I could still walk away with a small profit.
Well, I'll tell you, look, it's a good long-term story because it is one of the few. I mean, I was reading about Alcoa today and alumina and how great they're doing with that. There's always one mineral or another that's doing well, but you need to see China be stronger if you're going to own that stock. I don't see China happening. I just don't. They're doing everything they can. It's not working. So in that sense, I'd rather say weak hold. How about that? It's a weak hold for me. Let's go to Adam in Georgia, please. Adam.
Yes, I have Snap-on Tools, SNA. Should I sell or let it ride?
I thought that quarter was aberrant. I do not think that quarter was emblematic of what Snap-on can do. I think that you should hold Snap-on. I am have always been a big believer in the company, and I like small business too. The last quarter, look, it went up big, then it started coming back down. As far as I'm concerned, the right approach is that it's at 323. It was at 330. It was a good enough quarter. Hold on to it. It's only at 16 times earnings. I thought it was a really good quarter. Anyway, when it comes down to the material stocks like Nucor, I don't think you have to make a move right now. We can wait a couple of weeks until we know more about what the Fed is doing and where the economy is headed. Much more Mad Money ahead, including my exclusive with Prologis after the REIT slid on a recent earnings report, but that was really a downgrade by Goldman. Now, with new hearing features on the horizon for Apple's AirPods, I'm giving you my take on how big I think it could be for health and technology and Apple itself. Of course, all your calls rapid fire tonight, just a little lightning round. So stay with Cramer. What do we make of the stock of Prologis at these levels? This is a real estate investment trust that mostly owns warehouses and other logistics facilities. Last week, Prologis reported a strong quarter. Management raising their full-year forecast. Stock jumped 4.6% in response. While it's still down over 10% for the year, it might become a lot more attractive now that the Fed is finally our friend. And that 3.23% yield for a growth REIT is nothing to look down on. So let's take a closer look with Hamid Moghadam. He is the co-founder and CEO of Prologis. To learn more, Mr. Moghadam, welcome back to Mad Money.
Thank you, Jim. Hope you're doing well.
Oh, doing what? Your voice sounds better. I didn't hear you on the conference call. I got worried.
No, I had a case of mild COVID, I think.
Oh, okay. Well, look, I'm glad you're feeling better. I do want to ask you point blank. I felt that the conference call demonstrated you said bottoming out. But I've got to tell you, maybe I'm too bullish. I think it's already on the upswing. Disabuse me of that notion, because I think that the combination of what you're doing with generation capacity for data centers and the fact that the rest of the world seems to be coming back and that Amazon is doing so incredibly well, it seems to me that other than Southern California, things are pretty great.
I would say things are very good. I wouldn't say great. They're not as good as they were in 22 and 23. But Southern California is weak. We think it's going to take till the middle of next year before it firms up. And obviously, it's an important market, so it does weigh on our results. But look, I don't run this business for a quarter or 2 quarters or even a year. We run this business for the long term, and we have a tremendous mark-to-market embedded in our portfolio. And the growth of this company, particularly with all the new things that we're doing, data centers you mentioned, but also energy and mobility, I think our future is very bright, so I don't worry about the quarters.
Okay, if you had to go over the different corridors, for instance, when I look at 78 in the East, when I look at 95 in the East, I'm not, obviously this is a little bit too anecdotal, but I see that a lot of land's already been taken. It's not like you can add much warehouse space in the cities, and even along the interstates the land's taken. I mean, where can you possibly build if you wanted to build out new?
I think that's exactly the point that a lot of people miss. Just speaking about the West Coast, California just passed legislation. It's called AB 98 that severely limits the development of new warehouses. Now, that actually in the long term is really good for our business because we got a big footprint in California. So I think it's going to be increasingly difficult to bring on new supply in these major metro areas. And that's where the consumers are, and that's where the demand is. Nobody wants a warehouse in the middle of nowhere. So I think the supply picture in the next cycle is just going to be very, very difficult. And demand is going to normalize once the election is over and interest rates come down a little bit more. So I think everybody's got the handbrake on in terms of commitment to new space. And they've basically taken too much space in 22 and 23, and they're growing into that. But boy, when that is done, the amount of new construction that is coming on the market is really going down to a trickle. And it's going to be a very tight market in about a year.
Let me posit something. Between now and next year, about a year from now, the Amazon people I talk with would tell you that they intend to have same day for a dramatically larger number of products. What does same day mean for Prologis?
So the quicker the cycle time becomes for deliveries, the more the inventory you need to carry and the closer to the customer that inventory has to be. There's no other way to do it. You can't beam this stuff into somebody's house. So that just means more demand in major consumption centers. And, as you get to the center of the core, if you will, the amount of land available for development gets even less. So that's why, it's not just Amazon. It's everybody wants to be close to the customers. That's why owning land and distribution buildings in these major consumption markets is a really good thing to have for the long term.
Okay, that's very important because that's why I think the stock jumped. I think some people are getting ahead of it and realizes that, look, there's just not enough room left. Now, another thing that I think is important is that Larry Ellison is a man smarter than I know that I am. He says, listen, maybe we need 2,000 data centers for Oracle. He can't do it alone. He's not in the data center build series business. That's not him. That can be you. Are you seeing that kind of demand? People coming to you and saying, listen, we don't know how to do it, but we got to have it?
We are seeing insatiable demand for data centers. The governor on the amount of supply is the availability of power. And certainly the utilities alone are not going to be able to keep up with this demand. So you have to go to off-the-grid solutions, point solutions, fuel cells, other kinds of generation that is close to these data centers. And people are trying all kinds of things, including getting close to nuclear power plants and investing in SMR, small modular reactor technology, and many other things. So I think the power needs are insatiable. The demand appears to be insatiable. Now, technology change over time will probably reduce the amount of space that you need for these GPUs, and they're probably going to run a little bit cooler. I'm not a technologist, but Moore's Law is probably going to play some kind of a role in these chips. But ultimately, there is orders of magnitude more demand than what we're seeing here, and there's a really big rush to create supply of data centers to be able to process all this AI that's happening all around the world.
Can you convert empty spaces into something like that? Because you do say, look, I don't want to build. I can buy if I wanted to. You have a lot of cash if you wanted, but you have a lot of borrowing power. Is it something you would look at and say, listen, these spaces could be great because we have enough power to make it for data center? Or are the powers so insatiable that the grid just won't handle it right now?
No, all of the above. Not only we have almost 6,000 buildings in our portfolio. 150 of them have data center potential. That means they're near major power generation, they have access to fiber, and they're in markets that these users want to be. In addition to that, we control 9,000 acres of land, which can develop another 150 million square feet of real estate. Now, all of those will not be data centers, but we are in the best position. We also have these customer relationships because, interestingly, many of these hyperscalers are the people that we're doing business with anyway. So we think we're in an excellent position to take advantage of that. And by the way, this is not a new business for us. We built our first data center in 1999 in New England. We've got 20 of them in the Northern Virginia area. So this is a business we've been in. It's just scaling up at a very different level with this demand coming from AI.
And it is important to note, Amazon is a top 10 customer. Home Depot is a top 10 customer. Both of them are committed to cleaner skies. Amazon in particular may be the world leader. These are people who have to rely on people like you to be able to make this happen.
Absolutely. I'm very optimistic about the business. You cannot run a real estate business like you can run a tech business where quarter by quarter product cycles and what you do and all that are matter. 96% of our leases basically control our income for the next year. So there's very little that you can do with that space. And our leases are 40% below market rents. And no matter what happens to market rents, we're going to capture that growth plus all these other things that we've been talking about.
Well, that's exactly where I want to leave it because, I've liked your stock since 2009 when you were the first stock to bottom of all the companies, not just the REITs, but all the companies that I follow. Legendary bottom during the Great Recession. Hamid Moghadam is the chairman and CEO of Prologis PLD. Thank you so much for coming to the show. You look good, my friend.
Thank you, Jim. Good to see you.
All right, everybody's back here for the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the lightning round. This is my Ralph Corcoran. He's hitting the stock. I tell you about myself. Ready over the course of a year to play this out. And then the lightning round is over. Are you ready, Ski? Time for the lightning round. Let's start with Nick in Connecticut. Nick.
How are you, Jim?
I am good. How about you?
Good, thank you. Fast question. I would like to get your opinion on a company that is profitable, has somewhat of a subscription base, which I know we love, and is kind of in a niche area. Clear, secure?
Oh, Clear. You know what? I've wanted to have them on this show. I remember different iterations of these guys. I did not know they were making money until very recently. They should come on this show because it's not an expensive stock. Let's go to Brad in Illinois. Brad.
Hi, Jim. I wanted to have a quick question about Palantir Technologies. It has doubled in value since I originally bought it, but its price-to-earnings ratio is over 250. So I'm wondering, should I cash out while the going's good, or should I continue to hold?
Okay, this is a phenomena stock, not unlike GameStop, except there's obviously a better company than GameStop, and it's profitable. There is no level that the buyers won't take this stock higher. So I'm going to tell you that I would hold on to it as a spec and let them walk it up. I think the buyers want this to be the best performing stock in the S&P 500. I am not kidding. I think that is their goal, and I think they will accomplish that. Let's go to Will in Connecticut. Will.
How you doing, Jim?
I am doing good. How about you, Will?
I'm pretty good. I got to tell you, my mother's name is Louise as well.
Ma. That's sweet. That's sweet. And my niece. What's going on?
So as the Fed's going to cut these rates and mortgage rates are declining, how quickly do you think it's going to start to show up in building construction stocks, specifically SWK, Stanley Black?
Okay, so for my charitable trust, should we own this? I was kind of chasing today because Nucor, I thought everyone knew the business was going to be bad. It was bad, but then they gave you a discouraging forecast. I don't think Stanley Black & Decker is going to give you a discouraging forecast, so I'm going to say you're fine because it's also got a 3% yield. I'm going to continue to own it. We are not selling it. Let's go to Randy in New York. Randy.
Hey, Jim, club member from the beginning.
Yes.
From the Isle of Staten, and I'm talking about CVTX. They're doing a lot of things for the renal community, which really needs some breakthroughs. There hasn't been many in years. They've been approved for some stuff in Europe. They were just approved for something in the U.S., but it's not something that a lot of people have. What do you think?
Okay, I know they're losing a ton of money, so therefore, before I give it to Hyson, I have to have them on or do more work because it's losing so much money and the stock is up so much. I am afraid that I would hurt you if I said buy it here. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, will people be swapping earplugs for Apple AirPods at Taylor Swift's next concert? Lend an ear. Cramer's giving his take. Next.
I have a hearing loss problem. For some reason, it's taboo to talk about this subject. But you wouldn't believe how many people have the same issue. In my case, I did it to myself because I blast noise into my ears in order to block out tinnitus, which is an imaginary noise that drives me nuts. So I have to mask the sound. It's taboo to talk about that, too. I'm breaking some taboos here. My hearing loss problem is fairly recent. I now have to get my hearing checked somewhat regularly. I kept hoping the hearing would come back, but it won't. I'm being very matter-of-fact about this because many of you may be experiencing similar hearing loss. There are about 1 billion of us on this planet, and we all need hearing aids. But the stigma of a hearing aid is too much for many people. My late father hated wearing his, couldn't get his arthritic fingers to put them in well, too. Also really hard to change the battery. Made Pop tough to talk to. Like Pop, I fought it, too. But insult to injury, according to JAMA, that's the Journal of American Medical Association, hearing loss accounts for 8% of global dementia cases, rendering it the largest modifiable risk factor for dementia. In other words, if you have hearing loss, that could lead to dementia. Although my ear doctors say I can dramatically lower the dementia risk by simply wearing a hearing aid. So I bought the ones they recommended. Hey, I didn't know it when I bought them, but they cost $7,000. It's insane because they don't even work that well, and they aren't covered by insurance. It's a huge drag and, frankly, totally depressing. Okay, sob story over. I bring this up because the other day I read that my second-generation Apple AirPods Pro could serve as a hearing aid. I just needed to update my phone and set up the hearing and aid feature, and I could have something comparable to these $7,000 hearing aids. By the way, you'll be very easily test your hearing on your iPhone, and if you have mild to moderate hearing loss, as I do, you'll be able to turn your AirPods into hearing aids with zero stigma because people wear their AirPods all over the place anyway. I tried the public beta. Instead of going to the audiologist for tests to find out how much hearing I've lost and then searching for matching hearing aids, something that took me about an hour, not including my wait time, I took a test on my iPhone, and they were automatically matched. It took 5 minutes. Instead of spending $7,000, the hearing aid's already built into the $250 AirPods. If you own the AirPods, get the hearing aid capability. I then tested the AirPods all over the place. To me, they were superior to the $7,000 peer. Directionally better. I can cancel out the noise that I don't want instead of hearing what people say at the next table as well as I can hear my wife at my table. It helps me to recite all of this in a flat way because it keeps me from getting choked up about the whole darn process of it all. I'm not trying to be promotional here because I'm not an Apple salesman. I'm just someone who is sick of saying, pardon me, excuse me, hey, couldn't you repeat that? As well as, what'd you say? Did you say something different? I didn't hear that well. I don't want to increase my chances of dementia either. I want to decrease them. Years ago, I spoke with Apple CEO Tim Cook on this very show, and he told us that he wants his legacy to be about health. Listen to this.
If you zoom out into the future and you look back and you ask the question, what was Apple's greatest contribution to mankind? It will be about health. Because our business has always been about enriching people's lives, and as we've gotten into healthcare more and more, through the watch and through other things that we've created with Research Kit and Care Kit and putting your medical records on the iPhone. This is a huge deal, and it's something that is very important for people. We are democratizing it. We are taking what has been with the institutions and empowering the individual to manage their health. And we're just at the front end of this. But I do think, looking back in the future, you will answer that question. Apple's most important contribution to mankind has been in health.
Tim, your legacy's been cemented by the many health innovations in the phone and the watch. I don't need to repeat them. I just want to thank you and your team for doing this with the AirPods. I'm not going to wear the $7,000 hearing aids anymore. I'm not going to demand that we watch everything with 4-inch subtitles. I'm just going to wear Apple's great headphones. Hey, maybe 1 billion other people will too. Oh, and by the way, it's nice to hear well again, like I did before I hurt my ears. So thank you, Tim. Thank you, Apple. I like to say there's always a bull market somewhere. Promise try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.